So let's continue here to discuss now capital leases accounted for by the lessee. When one of the criteria is met in regards to a capital lease, then the lessee is going to record at the beginning of the lease an asset and a liability that's going to be equal to the sum of the present values of that minimum lease payment during the lease term. So the asset and the liability, the lessee has to take into account the executory costs, the discount rate, and the amortization on that leased asset, along with the reduction of the lease obligations. Executory costs are going to be insurance, property taxes, maintenance, and they can be paid by either party depending on how that contract is going to be written. Because the risks and the benefits of ownership have been transferred in a capital lease, generally the lessee is going to be responsible for these costs. And the lessor might pay the cost directly and then add them to the periodic lease payment. That's another way in which they can do it. If they do it in that way, then the lessee is going to exclude those executory costs from that minimum lease payment. And the minimum lease payment is going to be the lease payment minus those costs paid by the lessor. Now, as we talk about the discount rate, the lessee is going to determine the present value of those minimum lease payments. And they're going to determine that by using the lower of either the lessee's incremental borrowing rate or the lessor's implicit rate, or the lessee's implicit rate, or if it's practical for the lessee to even know it, if they even know what that's going to be. So they're going to use the lower of either of these. Now this incremental borrowing rate, it's that interest rate the lessee is normally going to pay if it were to borrow money to finance the purchase of an asset. So basically based on a secured loan and the asset as collateral. The implicit rate is going to be the interest rate used by the lessor to compute the minimum lease payments necessary to recover that fair value of the leased asset. So related to these rental payments by the lessee, when we're dealing with a capital lease, it may contain some contingent rental payments. GAAP can include or exclude them from the minimum lease payment based on what they are. If the contingent payment is based on usage of the asset, then it's going to be excluded from the minimum lease payment. But if that contingent payment is based on some index or inflation index, then it will be included in that minimum lease payment. The difference between the actual lease payment and that estimated payment is going to be expensed. So when we're dealing with amortization of the leased asset, the lessee is going to record on the books a corresponding asset with a corresponding liability. Now, because it's recognizing this as an asset, it needs to expense the use of this asset by allocating the cost over one or more periods, generally several periods, the life of the lease. And so basically this leased asset is going to get depreciated over the economic life or that leased term. So the lessee is going to depreciate the value based on its economic life to its residual value if that capital lease agreement either transfers the ownership or includes that bargain purchase option. If it doesn't transfer ownership to the lessee and it doesn't include a bargain purchase option, but basically it's still treated as a capital lease because of the other criteria, then the lessee is going to depreciate the leased asset over the lease term because its right to use the asset is going to end at the end of the lease. So basically depreciating the leased property either by the lessee or the lessor, as you can see here, with the lease agreement, is the ownership transferred. If the ownership is transferred, it becomes a capital lease. The lessee is going to depreciate the asset. Okay? In the case it becomes a capital lease, the lessor is going to treat it as the sale. So if the ownership isn't transferred, then we have to determine if it's a bargain purchase. If it is, then it's going to be depreciated by the lessee. If it's not a bargain purchase, then is the lease term greater than or equal to 75% of the life of the asset? If that's the case, then we're going to depreciate that asset, the lessee, over the term of the lease. If the MLP is greater than or equal to minimum lease payments greater than or equal to 90% of the fair value of the asset, then again, that's one of the criteria. We're going to depreciate it over the life of the lease. If it's not, it's going to be an operating lease. This is a great slide to keep near you so you can find the guidelines in which to determine when leases are capital or operating leases. Now, the reduction of the lease obligation, since the lessee is going to record a present value of the leased asset along with the corresponding liability, it's going to take into account an interest expense. It's going to reduce the lease obligation by the principal, and then after it does that, it's also going to compute interest each period by taking that discount rate to that outstanding balance at the beginning of each period and increasing then the leased obligation with that interest rate. Here's an example we'll go through here. This equipment is leased and the lease doesn't transfer ownership or it doesn't provide a bargain purchase option. So we will look here and determine how we're going to handle this, but it's a 4-year term. The lease terms for 4 years, non-cancelable, equal payments of $32,923 at the end of each year. The cost and fair value of the equipment at the inception is $100,000. The equipment has an economic life of 4 years and has a 0 estimated residual value. So we know right there we are using the equipment for greater than 75% of the economic life of the asset. So we'll know it's going to be a capital lease. It doesn't guarantee residual value. Hawk's going to pay executory costs for maintenance, and the equipment reverts to Deb at the end of the 4 years. So there's no transfer of ownership or bargain purchase. The incremental borrowing rate's 12.5%, but the interest rate implicit for the lease is 12%. So as we move along with this example, the agreement is to pay executory costs for maintenance of $4,000 per year directly on December 31st of each year. And the incremental borrowing rate is 12.5%. Hawk's going to use the straight line method to record depreciation. The interest rate implicit in the lease is 12%, and Hawk knows this rate. The present value of an ordinary annuity of 4 payments of $32,923.45 at 12% is $100,000. So no residual value. So there is no transfer of ownership or there's not a bargain purchase option, but the lease term is 75% or more of the economic life, and the present value of the minimum lease payments is 90% or more of the fair value. So this is a capital lease because one of these criteria have been met. Actually, 2 have been met. It meets 2 of those 4 requirements. So now, since it's a capital lease, Hawk's going to record the leased asset at the present value of the minimum lease payments using that 12% interest rate implicit in the lease. Now we assume Hawk knows this rate because it's the rate, that rate's lower than the incremental borrowing rate. Hawk also ensures that the capitalized amount does not exceed the fair value of the leased asset. So Hawk's going to pay those executory costs directly and expense these costs when they're incurred. So recording the acquisition of the lease, we're going to record it as the present value. We're going to debit the leased equipment, and we're going to credit equally that capital lease obligation. Now, the first annual payment and recognition of interest on the capital lease, we're going to show the interest expense by reporting the rate of 12% on $100,000 or $12,000. We know the payment is $32,923.45. So that difference is going to be debited to the capital lease obligation as a reduction of the capital lease obligation. This amount is being paid at the end of the year. So in this case, this annuity is considered an ordinary annuity. If it's at the beginning of the year, it's an annuity due. So this is an ordinary annuity. We then are going to recognize our depreciation on this asset, $100,000, the present value, divide that by 4 years. So we'll show a depreciation expense of $25,000, and we'll accumulated the depreciation of $25,000. Now, it's being depreciated over the lease term since that lease doesn't have transfer of ownership or there's not a bargain purchase option. So we're just using the annual depreciation of the life of the lease. Now the balance sheet for Hawk is going to include the leased equipment minus that accumulated depreciation, and it's going to divide the capital lease obligation between current liabilities and long-term liabilities based on the current payment of that lease obligation. Now, to treat the executory costs, those are going to be an expense in the current period, insurance, maintenance. They're just regular operating expenses. When we start working with the second annual payment, we're going to again calculate that interest expense based on the new obligation of $79,076.55. At that 12% rate is going to give us an interest expense of $9,489.19. Again, we know our annual payment of $32,923.45. So the difference between that annual payment and the interest expense is going to be that lease obligation. You can see here how this is determined. We start with the $100,000 value, and from there we take our annual lease payment, subtract from it the interest, and the difference is going to be applied to the lease obligation. And you can see at the end of year 4 the balance of the lease obligation is 0. Again, the depreciation will be a straight line at $25,000. We'll record this just like we would a normal asset, a depreciation expense and an accumulated depreciation. So when the lessee classifies its capital obligation on its balance sheet, it considers various criteria to determine if the leased portion of the payment is current or non-current. GAAP doesn't provide guidelines to measure this, so there's 2 ways they can look at that. Under the present value of next year's payment, the amount of the lessee's current liability is going to be the payment the lessee will make in the next year discounted to that balance sheet date. Or they can change do a changed present value approach. The current liability is the amount by which the total balance of the lease liability is going to decrease in the next year. So basically, what we're going to do in this respect is look at an example where the lease payments are paid in the beginning of the year. This is going to be similar to the problem I showed you in exercise, I believe, 23 or 22. But the lease provisions described are the same, except the payments happen in advance. And we're showing the cost and the fair value of this equipment as $112,000. So this is now, we're going to use a different chart for this. It's going to be the annuity due table instead of the ordinary annuity table. So when we look at the present value of these annuity due, we're going to have $112,000 here. again, looking at the chart here, you can see the obligation starts at $112,000. The annual lease payment is subtracted right away because it's at the beginning of the period, and the interest will be paid on the remaining capital lease obligation. So that interest payment of 12% is going to occur on the $79,076.55 in this case, because of the fact that this was an annuity due at the beginning of the period instead of an ordinary annuity. Make sure you see here the initial lease payment gets subtracted from the lease obligation. That remaining balance, then the interest is calculated at 12% on that balance to come up with the interest that gets added to that lease obligation. And again, the lease payment for January 1st again is subtracted from that lease obligation, and the interest for the December 31st, 2014 is going to be determined based on the loan balance of the obligation of $55,642.29. So recording these journal entries, again, we are going to debit and credit the exact same amount, record an asset and also a liability of $112. When we record the first payment, it's going to be different than an ordinary annuity because the entire amount is going to go against the lease obligation. And then when we record the depreciation, and then the interest expense is going to be recorded at the end of the year. Also, any of the executory costs are going to be expensed each year as just an ordinary expense in the period. And as you can see here, we show the second annual payment. The entire amount is going to be shown as a capital lease obligation. The entire amount of $32,923.45 is treated as cash. The portion that is accrued interest is going to be offset. The difference will then be that capital lease obligation in year 2. We're not going to spend time in this chapter talking about bargain purchase options, so just know the main focus I want you to look at relate to the ordinary operating leases and capital leases. We're not going to focus on the bargain purchase or guaranteed residual value. So I will use the next lecture I post. We'll work through some of the problems for this chapter.